that everything that goes up a lot in a short period of time, whether there's value in whatever it is or not, you get the feeling it's a place to be. You do. You get the feeling that if I just put my money in there and I want to wait, I'm not sure it's okay. And finally, it goes up high enough, it feels like it's okay. And guess what? It is not. And what do? You buy mutual funds. And I'm not going to spend a lot of time going into mutual funds. You will with your students. But I mean, you get in a mutual fund the combination of a whole bunch of money from a whole bunch of people with a professional manager that takes care of it and does the right thing and diversifies over many, many companies. And yes, there's less risk when you have many. I owned Enron. I owned Washington Mutual. I owned things that failed, but they were in these funds where there were literally my portfolio and your portfolio too can have 10 to 15,000 companies. And yeah, they go out of business. In fact, that 10% compound rate of return I talked about earlier, that includes those companies going out of business. So what we know is there's less risk. But here's the kicker, and it's a great kicker. With more diversification comes a higher expected long-term return, not lower. Normally, you see when you get less risk, the suggestion is that you're going to get a lower return. But with diversification, it turns out historically, you get a better rate of return. As a matter of fact, there's a study by Dr. Bessembinder out of the Arizona State University. And the question of this study was, do stocks outperform treasury bills? Treasury bills have about a 3% compound rate of return historically, stocks about 10. Well, you okay there?
If you want laptop, I can give you a laptop.
Okay. All right. So the question is then, do stocks outperform treasury bills? Well, as I mentioned, from the period of 1928 to 2016, that was the period the market made 10, but 4% of the companies, 1 out of 25, made huge returns. General Motors was one of those companies, huge returns. And then they went into bankruptcy. But for a long time, they made huge returns. And that was true of a number of those very famous. Enron, huge returns. One of the 7th largest companies, and then no value. But 96% of the companies made on average, these are all the public companies from 1928 or 28 to 2016, made 3% a year. Over 50% of the companies didn't make any money over the long term. Okay, that happens. Now, what do we know? If you bought them all, you got the 10. If you tried to be a smarty pants and try to pick your favorite 10 because you know something the rest of the market doesn't know, then maybe you do better, maybe you won't. I mean, people do win lotteries, so it's not like nobody wins lotteries. Yeah, some will. But what we're looking to do is to take care and make sure people get a return that will lead them to the outcome they want. Now, the dream outcome is to be wildly rich. That's the lotto. But the other dream that means you have millions because you saved thousands, that is not a big deal. It's just simple math. The question is, how can you access the simple math? And here's a killer. This one is fantastic because this is what the academic community, and by the way, those are the people I trust. You can trust Wall Street, the insurance companies and the brokerage companies and the banks and everything. I don't. You can trust Main Street, your neighbors and your friends and folks at the office. I don't. or you can trust the academic community, what I call University Street. I do. I can legitimately say I do to the academic community. I don't mean that they're going to tell me what the future of the stock market is. They can't do that. But they can tell us the things where we can control risk. And the one risk that, if you can control it, leads to higher rates of return, more than 0.5%. I mean, this is important. We're talking about an extra $1 million for investors who buy mutual funds who have low expenses instead of higher expenses. So we'll talk about how to do that. But I can tell you right now that there are mutual funds that their average expense ratio every year is 1 to 2% a year. Or you can buy mutual funds that have 0 expense per year to manage, or 1/10 of 1%, or 1/20th of 1%. And there's nothing tricky. There's no magic trick. And these mutual funds that in fact charge these low expenses, and by the way, they don't charge any expense to buy them. They are free to buy. They are free to sell. And the management expenses inside to manage those funds are close to nothing. And those funds literally manage trillions of dollars, trillions. Now, where's the big money made? In the funds that can convince you, no, you should pay us more because we're going to make you more. They don't know they're going to make you more. In fact, the funds I want us to recommend to our students are the funds that, while they're not guaranteed to make more, historically index funds, passively managed funds, funds that own all of the companies that are considered large, all of the companies that are considered small, all of the companies that are considered to own growth companies, all of the companies that are considered to hold value companies. They don't try to pick the best. They don't try to second guess the market. They buy the market. And here's what is fascinating. There's a company, Standard & Poor's, that tracks how well all these different kind of funds do. So these index funds, they try to be the market, not to beat it, to be. They emulate it. They have this teeny tiny fee that comes off the top. I mean, it is teeny tiny, less than, let's say, 1/10 of 1%, as opposed to 1 or up to 2%. And what we know is from these studies, if you look at 20-year periods, and 20-year periods to these young people we're trying to teach, I mean, that's when they're just doing baby steps then, that first 20 years, but they're building the base. And we'll talk about how important that base is, hopefully, before I get done. Those index funds and that in the benchmark, only 10% of actively managed funds are able to beat the index funds, which means, okay, we got a choice. It's a fork in the road. We can trust the sales pitches that come out of Wall Street about why this Goldman Sachs fund is better than the Oppenheimer fund or whatever it might be. But the bottom line is that that's a sales pitch. It is full of blue sky because they don't know. But the reality is, historically, and that's all we have that we can measure, is the past. You can never measure a sales pitch. But it's what they've got. Chrysler has it over Ford. They all have a sales pitch for why they are better than somebody else. Just go to the dealership and listen. How often do they ever tell you, you'd be much better off with a Chevy? Really? You ought to go over there. No, they're going to tell you what they want to sell. That's how they make a living. And I don't fault them for that. That's okay. That's the way the capitalistic system works. Everybody's got a sales force telling a story. But you need to control your story. See, this is the thing. They want your story to look like their sales pitch. They make money. And our young people need to understand that. You are the one to create the story, and index funds are absolutely such an easy decision. They give you low expenses. They give you massive diversification. They give you low trading costs inside because they don't trade very often. So here's some numbers. If you look at the last 94 years, short-term government bonds, STGB, very low risk, compounded at 3.3% a year over 94 years. And the international government bonds that have longer maturities, therefore they have a little more volatility, their compound rate of return was 5% a year. If you were in long-term government bonds, they made more, 5.6%. But look at their worst year was a loss of 15% versus a loss of 5% versus a loss of 0.02%. High stability, 3.3. Lower stability, 5.6. $100 over 94 years grows to $2,000 in the T-bills, $10,000 in the intermediate, and $16,000 in long-term government bonds. There is the relationship for risk and return. If you take more risk in most cases, remember I said diversification, that's not true, but in most cases, you make a better rate of return with more risk over the long term. Now, if we look at, and I know I'm talking too much here and I want to get caught up. I'm going to go to 40 years if I might. Average 40 years, compound rate of return, 4.5, 5.9, and 5.8. Well, that's kind of interesting. It turns out that actually the intermediate term bonds did better as a compound rate of return than the more risky long-term government bonds. Now let's look at equities. I'm going to do this quickly, and you're going to read about it, or you already have read about it in the book. But I think our young people should be taught. Now, this is a reach because we want to keep it simple. We don't want to confuse them. But we're talking about life-changing information. If all you own was an index of the large companies, some growth, some value. The growth, those are the ones that are in favor. Those are the ones people are excited about, like Tesla, NVIDIA. I mean, you could go on and list names that young people might know. At the other end of the spectrum are the they're not dogs. They're just not very exciting. They make money, most of them. Well, as a matter of fact, many of the technology companies don't make much money. They're planning on it someday, but right now they're focused on growing. And people are willing to pay a lot for those because the future looks so great. And by the way, when those companies stumble, whoa, they can fall 50, 60, 70% in a matter of a few months if people lose that hope of the great return. But value stocks, they were never very exciting in the first place. But look at this. The same $100 a year in the S&P 500, grew to be worth over $900,000. 10.2% compound rate of return. If you took out the growth, remember the growth companies that were so exciting and so neat to be in? If you got rid of those companies because so many of them don't do well, it turns out those doggy kind of out of sight companies that people don't get excited about actually ended up making 11.2%, or the $100 grew to $2 million. And if you put the money in small companies, by the way, these big companies are multi-billion-dollar companies. maybe companies on average of $200 or $300 billion in value. Whereas the small companies, public companies, may be worth $3 billion in value, but they have room to grow. They have a future ahead of them. And historically, those companies as a group compounded at 12.1%. And then if you looked, and some of those were growth and some of those were value. But if we took out all of the growth companies that were small and left just the value ones, their compound rate of return was 13.4, and $100 grew to over $13 million. Now, we're not going to have time to get in it today, but you will be able to get into it. And that is if you get into the articles that we have on our website on combining these different, like here's a combo. You combine half small cap value and half large cap value. You can see that the compound rate of return was about 12.5%. So it would have been somewhere between the 4.5 and the $13 million. And it wouldn't have had the same volatility. I want to go out to 40 years. I want you to be able to look these kids in the eye and say, look, I know how safe those bonds are. I know we love it. We love it when the things we own don't go down a lot, but those that don't go down a lot, they also don't go up a lot. But stocks have a history of success, particularly for the long run. And the average compound rate of return of the S&P 500, 11, 13.5 for large cap value, 13.7 for small cap blend, and 16.2 for small cap value. And if you looked at the worst, the worst 40 years for the S&P 500, that is the highest quality of all of these equity asset classes. The compound rate of return was 8.9. That's a great rate of return for a lifetime, and that was the worst. So I want you to add some small cap. I'm talking now to you as an individual person. You may not want to go this deep with these kids, but for you, I want you to have some small cap in your portfolio. You're looking to look for an extra 0.5%, it's there. I want you to add some value to your portfolio. Looking for an extra 0.5%, it's there. Of course, this does assume you have stocks in your portfolio. Now, I know you can't see all these small numbers, but I want to show you something really interesting, and I'm going to show it to you in big numbers. But these columns, every one of these columns is a combination of the S&P 500, and every time you move to the right 10%, you're adding some small cap value. So with one fund, we can pick up the small premium and the value premium, and we put that together with some amount of S&P 500, these large established companies. And what does that do to returns, and what does it do to risk? Well, I want you to see, here's the S&P 500 from 1970. This is from 1970 through 2021. The S&P 500 compounded at 11% here on the far right, okay? If you added 10% to that portfolio and have 90% in small cap in S&P 500 and 10% in small cap value, you'd have 11.4%. There's 0.4%. Okay, I didn't get you to 0.5%, but I got you to 0.4%. And the worst 12 months for the S&P 500 was 43.3 versus 43.9. That's basically the same thing. In fact, if I could get you to go to 30% in small cap value and 70% in the S&P 500, the long-term compound rate of return was 12.1%. The worst 12 months was a loss of 45% versus 43%. When you're down 43% because the market's going through a tough period, do you think you're going to care if it's 43 or 45? But the fact is that over a very long period of time, by the way, we have studies going back to 1928, these small amounts of small cap value make a huge difference. A huge difference. Because remember, 0.5% was huge. 1% was twice of 0.5%, and you're going to be doing other parts. You're going to be in index funds and not in actively managed. You're going to have low expenses. Not you're going to do everything right. But this is frosting on the cake. Here's one of the worst things you can do: market timing. Now, I know a lot about market timing. I'm even kind of an expert on market timing. I've studied market timing, and the problem with market timing, what it is having some reason why it's time to get out of the market. Well, I can tell you it's always time to get out of the market. If what you're afraid of is losing money, there's always a risk of loss. As a matter of fact, the greatest risk of loss is when you're doing well. The greatest opportunity for gain is when the market's down. It's kind of backwards for how we think. But what we know is the people who try to second guess the market make about half as much as the market. Now think about that. You're ending up making more like bond returns instead of stock returns because you thought you could outsmart the market. One bad market timing move where you get out of the market and you go to cash, waiting to get back in when the time is right. How are you going to know when the time is right? Nobody knows. But in the meantime, you're in there, you're punching and you're fighting, you're doing everything you can to arm wrestle the market. It's too big to wrestle with, is my experience. They know better than you. Now, if you don't have the ability to accept major amounts of loss along the way, that means you probably need to have some bonds in your portfolio. And that's part of the work we do on our site, is we show people who are do-it-yourself investors, all right, you don't have much risk tolerance. How much do you need in bonds? That's part of another presentation. Dollar cost averaging. I love this. I love the word guaranteed. When you dollar cost average in, your young people need to understand, okay, you're putting $100 a month in there every month. It's like a 401k would normally be done, or a 403b. $100 a month. You're buying those shares. And when the market goes down, guaranteed to buy more. If you were buying shares, $100 of $10 shares, you got 10 shares. And then it goes down to 5, you buy 20 shares. Then it goes down to 1, you're buying 100 shares. When it goes up, you buy fewer shares. And over time, you will have purchased way more shares at low prices than we likely would ever, based on how we feel about it. Because when the market is down, we feel like it's going down forever. So we're afraid of it. Dollar cost averaging said, you're a buy and holder. You just keep going. Now, don't keep going into one stock, but if you're going into an index that has a 100-year, actually, in a way, they also looked at 200-year history of success when you own everything, it is $1 million decision, dollar cost averaging. And we know this. God, do we know this? Is that you get your money into a tax-deferred or a tax-free investment that you are going to come out way more than if you're then you have a taxable investment. And the beauty is today, I didn't have this when I was young. You have access to a Roth. I hope you have access to a Roth. Well, you have an IRA, but you also potentially could have a Roth 401k. And here's what I believe. I think this is worth teaching kids. The Roth IRA is no different from the tax-deferred IRA that most people are used to investing in, or like a 401k, where you invest money in the 401k and you get a tax write-off, or in an IRA and you get a tax write-off and you get a refund from taxes. You get money back because you did that IRA, you did that 401k. You see, if you take that money and you simply reinvest it, you in essence have the same thing as a Roth IRA or a Roth 401k. But people don't reinvest mostly in their Roth or their IRA or their 401k. They take that money and they enjoy it. And that's wonderful. I understand that. But with the Roth, it tricks you in a way, because by not getting that refund, what you're getting in exchange is tax-free growth for life and tax-free distributions for life. Now, when I said that there's no difference between the two, a tax deferred or a tax free, if you reinvest, if you all of the money you get back. But here's the thing that I think is the big decision that nobody knows, and I'm willing to take a stand because I've been there. It's anecdotal, okay? I came into this industry in the mid-60s. When I came into this industry in 1966, and I started investing in 1963. When I came in, well, right before I went into the industry, the marginal tax rate was 90%. 90% over a certain number of dollars. If you made over, let's say, maybe $90,000. Now, $90,000 was meant a lot more then, because inflation hadn't built the value of money up to what it is today. But when you are 70, and if the tax rate is 90% or 70%, it went down to 70%. Today, it's in the mid-30s, basically, for most people. Well, for most people, most people pay less than 25% in taxes. But to the extent that you're going to have a lot of money, you've taken money out and not paying taxes on it, you might have neighbors that are paying 70% on taxes. You're paying zero. I think it is a risk worth taking. Plus, it forces you, in essence, to have all the money that you put into the Roth IRA, you put into the Roth 401k, have it go to work and stay there, growing, tax-free. And also, a Roth allows you the ability to not have to take minimum required distributions if you don't want to. Target date funds. Half of my book is about target date funds. I should say our book. Rich Buck has been writing with me for, 30 years, I think. And Rich is actually a writer. I'm pretty much a thinker and an editor, but it's a good partnership, and we continue to do it even in retirement. By the way, we have some what I'll call heavy hitters in our organization that have a lot of experience, and most of the people who do the heavy lifting in terms of research and whatnot, they are volunteers. I am a volunteer. I don't get paid a penny. You will get to know Chris Pedersen and Daryl Balls if you become a regular visitor to our podcast and our videos. These are smart, experienced people trying to help you. They are not being paid a penny. It is because they really want to help you and the people that you're teaching. So, target date fund. This is what probably 99% of your students should have, a target date fund. What it does, when you make your first investment, you basically tell the mutual fund company, I want to retire in 2070. Okay, then we know you're a young person with lots of years till retirement. So we're gonna take care of your money and expose you to the risk that you should have. at age 20, at age 25, 30, 35, 40, 45. They're changing it. They're not market timing. They're not bouncing in and out for you. They are simply exposing you to the right amount of equity and fixed income. And then when you retire, they keep doing it. If you were in the Vanguard, a target date fund, and you're my age, they have you 30% in equities, 70% in fixed income. If you were your age, 20, with your student's age, they'd have them 90% in equity and 10% in fixed income. They are professionally managed these funds way better than individuals would do on their own. In fact, Wharton did a very serious study over a long period of time looking at 1.2 million accounts, and the advantage to the people who use target date funds is expected to be about 2.3% a year better. And I'm looking for 0.5%. This is, and Valerie, I don't think you've seen this piece. I want to talk about something we need to have our young people understand. They are about to enter into a partnership. I think this is really important. They are not prepared to do all the things and to know all the things that they need to know to be a successful investor. Having said that, anybody can buy a lottery ticket, I think, if you're 21, I suspect. So what happens is this. The young person as an investor takes the important step of investing. And that step is way more important than they understand. They think they're a little pee-wee person without any importance, and they're going into this great big giant market with a little bit of money. No, it's all they got. And it's a lot of money. They just don't know it yet. It gets to be a lot of money over time. But oftentimes, they want it to happen now. But in the first 10 years, the real heavy lifting is not from the market. You shouldn't be looking at your returns and say, hey, what's the problem with you, Mr. Market? You know, I'm doing my part. Why aren't you making me rich? Because young investors oftentimes don't understand. Very few people get rich quickly. It's over time. And it's that money that you put in that carries the day for the first 10 or 20 years. And let me just give you one example. At the end of the first year, you put in, let's say, $1,000. You put in $83.33 a month. You put in $1,000, and let's say it's a year that the market is up 10%. So then you have $1,000 plus, 10% of pieces of money that were put in monthly, but it's not going to be $1,100. It's going to be something less. So let's say it's worth $1,100.